Welcome back to Retirement News Online. So when planning for retirement, most people are focused on saving and investing wisely, both very important elements of any retirement plan. However, beyond understanding just how much you need to save now for your future retirement, it's also important to understand how future taxes may impact your retirement income. Now, tax planning is a crucial element in securing and ensuring that your retirement years are financially stable and secure. Because without a tax strategy, taxes in your retirement years can quickly eat up a large portion of your savings, leaving you with less money than you planned for. Joining me is Kaden Wren with Prime Capital Financial in Scott City, Kansas. And Kaden, talk about the difference between tax prep and tax planning.
Yeah, thanks, Scott. So I guess first off, tax prep, think of it more as something that is kind of reactive rather than proactive. So tax prep, at the end of the year, you go and file your taxes, make sure you're compliant, and it's more of a reactive step. Now, tax planning, complete opposite. It is proactive. So it's something that you're kind of revisiting maybe every year and just trying to minimize your tax liability for your entire lifetime.
So retirees often expect to pay less taxes in retirement, but that isn't always true, is it?
No, not at all. A lot of people don't take into consideration something called RMDs, or required minimum distributions. When you reach age 73 or potentially 75 for the younger generation, you have to withdraw a certain amount out of qualified retirement funds, whether that's your 401k or an IRA. And those RMDs are taxed as ordinary income. So, if you're spending more, you're going on vacations and pulling more out of those tax deferred accounts such as IRAs, you're going to incur a lot more taxes on those. A lot of people also don't realize, that Social Security is taxed based off of your income level.
And since we're talking about income, how is Social Security income taxed?
So I guess I just kind of led right into that question with my previous answer, but it's taxed three different ways. The first way, it's not taxed at all. There's 0% if your income is below a certain threshold. Now, if your income is between these two numbers, I'm not going to spit them out and be all nerdy on camera for you, but it's taxed at 50%. So half of your Social Security is taxed at your ordinary income tax rate. And then if you're above the threshold number, it's 85% of your Social Security is taxed.
How does somebody know if they have the right advisor?
Yeah, so that's a question. If you're asking it, in my opinion, you might not have the right financial advisor, and it might be good just to go look around, get a couple second, third opinions, whatever it may be, and ask a couple other advisors things. And when you're talking to those other advisors, things to consider are, is that advisor just managing your investments, or are they looking at your entire financial picture and kind of creating out a roadmap for you to live your ideal financial future? Are they taking into consideration taxes? Is your situation as tax efficient as possible? Are they asking if you have the proper estate documents in place or proper beneficiaries on all your different accounts? And just having a good relationship with your advisor and being able to trust them and talk deeply about your personal situation is very important. So you want to be comfortable with the person who your advisor is.
That's Kaden Wren in Scott City, Kansas, and this is Retirement News Online.